Now we show how to use the option strategy optimum tool for finding a maximum expected return strategy following a directional market sentiment. Today on July 19th of 2020, we decided to trade options on the Home Depot stock, taking options from the option chain expiring on September the 17th of 2020. So expiration is 2 months away from the current date. We will be using domain with 12 strike prices, starting on $235 and ending on $290. Also assume that we decided to trade not more than 4 option contracts. This limit can be defined by any figure. Theoretically, there is no restrictions on this figure, but this figure is restricted by your subscription level. By default, it is just 4 option contracts. Here you type the commission fees of your broker, commission per trade, commission per contract, and assume that you do not have any idea about market direction, market sentiment. You do not have any market sentiment. And in this case, you can keep the direction type indefinite. In this case, you will rely on the market sentiment implied by option deltas. But if you do have a market sentiment, say bullish, and push maximize expected return. And this is the optimal strategy with this expected return of $2,393.74 and with the probability of profit of 44.11%. This strategy may not good for us because we see the break-even point here is around $13 away from the current market price. But the tool can reduce this difference. For example, let us raise the support pole of height 0 at the strike price 265. What it means that we will ask the tool to find the optimal strategy that goes over this support pole depicted here by the yellow arrow. In this case, the optimal strategy will have at most $5 difference between stock market price and the break-even point. Let us push maximize expected return, and we have a new strategy. The expected return has been reduced almost twice, but the probability of profit has been increased by more than 9%. We'll look at the strategy carefully and this profile and say, but this strategy has a downside risk. So let us go to the entire option chain view and see that the profile goes down and if the stock market price goes down, and the maximum loss is unlimited. But we can fix this issue by the requirement that the upper bound of the bear slope should be 0. So put 0 here and click maximize expected return. And now we have a new strategy without downside risk. But if you look at the code of this strategy, it's still not very good because it involves short positions in the money options. This put with the strike 265 is in the money and in the short position. It is depicted here by the red color font at the pink background. But again, the tool can resolve this issue by ticking this box. This box says avoid short in the money options, and again click on the maximize expected return button, and we have a strategy. It's barely noticeable the difference between the previous one, but this strategy does not involve short positions in the money options. Again, let us estimate the maximum loss. This is 4,951.95. It's almost $5,000, but assume that we cannot afford more than $4,000 in the maximum loss. Then let us set the corridor floor at the level of $4,000. So, and again, click maximize expected return, and we have a new strategy that observes the floor of $4,000, shown here by the purple color. And let us try to improve this strategy anyway, by raising this support pole up to the height $500, and push maximize expected return, and we have even better strategy. Break-even point here is just $2 away from the current stock price, but let us make it even smaller, even less than current stock market price. In this case, we should require a raising the support pole of height 0 at the strike price of 260, and in this case the break-even point must be less than the current stock market price. Push maximize expected return, and we have a wonderful strategy that is called in our classification a long call iron heron, and we can trade it right away. But let us try to improve it. So currently we have expected return of 424.46, and the probability of profit 58.35%, which is pretty good. Let us raise another support pole at the height 2000, say 2000. Then maximize expected return, and we have a broken spread. So the probability of profit has not been increased, but the expected return has become negative. So that's why probably we should return to the previous strategy and trade this strategy. If you want to try this tool by yourself, go to algorithmic.com and open your own account.